The equation that changes everything about how you trade. Well, it's a bold statement, but that is what we're going to talk about today. And be prepared, in the end, there is a surprise for you. Some of you at least. As always, there's no financial advice or investing advice in this video. We are going to look at this from a Bitcoin perspective. I'm going to give you a way of thinking and assessing the situation when you look at probabilities but also outcomes. Often people are striving to find an indicator that is having 60% win rate, 70% or whatever. But the win rate doesn't mean anything unless you also take into account how much will you gain if trades are going in your direction. For example, if I'm rolling the dice, there are 6 sides, and if I am betting on number 6, I only have 1 chance out of 6 to win. That is a pretty low win rate. Still, that could be a perfect strategy. If I'm, let's say, making 12 times my money every time I win, I will on average double my money. And if you've been on this channel before, you know I always look at trend lines. I talk about upside versus downside much more than probabilities, even though the probabilities also are an important part of the full equation. So I'm going to give you an example here, and then I will show you how you can solve this. And it's both a way conceptually to think, and it's also math that you can do down to the exact probabilities of each outcome. And for that, I have a surprise in the end. Let's start with this case. This is a Bitcoin forecasting model I've covered in other videos. It's called a noise-reduced Euler's exponential. It's a super smart way to do forecasting, but that's not the topic for now. Let's just say that I believe somewhat in this model, and therefore I am going to pretend that I'm going to buy Bitcoin now, and we say we're at 60K. And this model say will be in 300K in about 3 years, maybe 3.5. Doesn't matter really. But that's not the only outcome. This model could of course be wrong, and it could be wrong both in the upside direction or the downside direction. So the question now is, can I guesstimate some probabilities of this model being wrong? Can I guesstimate some chances that it is right? And how does that impact the potential trade here? What is the likely outcome? Let's start with the bear case. Let's say that there is some risk that Bitcoin is at 6K here in 3-4 years when I plan to exit if I buy today and have that time perspective. This can be on day trading any time perspective. This example is for a long-term trade. And of course, 6K, there must be some scenarios behind that. We'll not cover them here. But we do know that we have had quite a handful of millions, like 5-6 millions of Bitcoins bought in this bull run and this pullback by unknown buyers. We just know there are big money buying it. You can see that on the size of the addresses, but we don't know who. We know what went to sale, we know what went to the ETFs at BlackRock and others, but there's still some or probably multiple buyers that are unknown. So let's say they all bought Bitcoin with bad intentions, so they're just going to dump it and crash it and do whatever they can. Maybe this scenario could happen. We'll come back to the probabilities soon. Then we have another scenario that Bitcoin stops going exponential. Maybe it just goes sideways. If you remember, Ethereum have done that. This is Ethereum, and it's the 2021 bull run. And here we have whatever this was in 2026, or 2025. And in the beginning, many thought that we were going to do an exponential bull run as Bitcoin. We were probably the first channel that called this like 2 years ahead of time that we do not think so. We think it's just going in this channel. Could this happen to Bitcoin, that it stopped going exponential and just going in a linear channel instead? I guess it could. It has pretty much happened to all other altcoins, in fact. And then we have next scenario, which is that we follow this prediction, a prediction that have been quite accurate in the past. For each bull run, we've been following these type of predictions, and also the bear market so far have been following a similar type of prediction. And then, of course, we could go above this prediction. We do not have much data yet for the next bull run, if we still are in a 4-year cycle or something similar. Now you might think, oh, this the only, can't we go higher than 900K? Well, we can, but I will just have 4 examples in this example to not get too big. Then we will come back to this and play around with the numbers later on. This is to demonstrate the concept, how to think, and how you should do the statistics, the math behind. But definitely, I can tell you there are scenarios where we go to several millions in just a few years. There's just actually, in my opinion, two things that needs to happen to trigger that. One is that the micro strategy, or strategy these days with Michael Saylor, that they get listed on the S&P 500, so all passive income funds are forced to buy. That will give them a constant revenue stream to just keep buying Bitcoin. If also at the same time, or in addition to that, the US government will start to buy for a Bitcoin reserve, then you have two entities with very high likelihood keep buying. That itself drives the price, but it also means that everyone else, either institutions, countries, anyone that have been on the sidelines or dipped their toes, they would have to jump in, and then things could go really crazy really fast. Now that scenario is not in here because I'm starting with a cautious case and just putting now some probabilities. Your probabilities might be different. This is not about who is better with probabilities. It's about how changing the probabilities changes the outcomes. You know if you're doing something that is hanging on a thin thread, or if you're doing something that actually deemed to lose, but you don't even know it before you start. So I set here the 6K, I just say that's 5% risk that will happen. The 100K, I put 10% in. 300K, I put 70% in, and that means that the one, luckily, the leftover here needs to be 15, because the sum of these cases needs to be 100%. That's the only rule. And then you can have 2 cases or more cases. And we have covered in other videos how to do polynomial function to calculate the expected outcome, how to do decision trees and probabilities. And it's not that complicated if you have some basic math or probability training for this example. But when you take it farther, it becomes a bit heavy to do by hand. And even this case might very well be considered heavy. It all depends on your background. So here's a tool that will help us with this calculation. And it's me designing it. Well, the actual code is done by AI Agent. But I used to work for a company designing state-of-the-art tools for quants and traders and analysts for the financial industry, for the hedge funds, for the big banks, and in particular for the trading departments that were relying on quantitative analysis rather than fundamentals. So I put in current price, name, it's Bitcoin in this case. Then you can put names on the scenarios here. We will just skip that, we don't need any names. We had the first scenario that we go to 6K, and I gave that a 5% risk if I remember correctly. We had 100K, and I put that on 10%. We had 300K at 70%, and then we had 900K at 15%. And you don't need to fill in, you can fill up to 6 scenarios here. You can just fill in 2 if you want to, or up to 6. There are some calculations on the side here that I will skip for now, and then we'll go down to this dashboard here. And the key number is this one, expected returns. So this means that if I redo this trade thousands of times, what will be the average outcome? Now, if you do an exam in statistics, you should probably use the word expected returns, but basically it's the same thing. If I keep repeating this, where would I average end up? An average with these probabilities, which is just my guess, it's not about that I know these probabilities, and you might have your own and different assets. It works for any asset and any probabilities. That is the expected return, the average return. Then there's something called the expected price, which basically is what gives you this percent increase. And 492% is not 4.9 times your money, it's 5.9 times. Because 100% is 2 times, right? So 300% is not 3 times, it's 4 times. I see many do that wrong. Then you have the best case scenario, that is 1,400% returns. And worst case scenario is that we lose 90% of our asset. And then here in yellow, we can see how many of these scenarios entered that end up in gains or loss. And 95% of all scenarios end up in a profit. So these do not take into account how much profit you do, just if it's minus or plus. And then you also have some data on the bear, bull, and the different type of cases here and what they give on average. So it's a very simple dashboard that gives you expected outcome, which is the key. That's a combination of upside versus probabilities. And this is why, if you read, for example, BlackRock's report about the Bitcoin ETFs, which came in 2024 when they launched it, they talk about asymmetrical upside, and this is what they're talking about. They also talk about liquidity, that is very liquid and uncorrelated, and it's a hedge because traditional markets are not really working the way it used to work. But that's a different story. And I will come back to this dashboard a lot, because this is what I'm using all the time. It's just that I used to do the calculations manually, and sometimes I've done things in a commercial software or in Excel or MATLAB or whatever. But now when I have these AI agents, I'm trying to rebuild the useful tools that I have seen and worked with in the past. I don't have to do the programming. It's many years ago I was a programmer. I've just been doing the math and statistics and business aspect of things. I will give you one example where we have used this kind of thinking besides this one, and then we'll come back to this one or to this application in many videos going forward. Well, if you were on this channel in 2025, I said when Ether were down here that I'm going to take a trade on it because we're on a trend line. And the downside is not so high and the upside is quite decent. And then we use this regression channel and put probabilities. What is the probability for us bouncing before we hit this regression limit here? And I put in a number for that, probably 80%. And then it will be like 20% that we keep going down. And if we go up, how high will we be? And maybe I put one number to that we reach here and another probability to that we reach here, and then a small one that we break out of this channel. Or maybe I didn't not even consider that because my main thesis was that we will keep remaining in this channel. Since we already back in 2024 said that Ethereum and also are not going to follow Bitcoin in the exponential bull run. And consequently, we also sold when we're up here. Now, this looks very easy when you look at the chart, but when we go back here, there was this panic in the market and people were competing to short Ethereum, even the ones who had been bullish for ETH, all this time waiting for it to go parabolic and follow Bitcoin, and even outperform Bitcoin. So it was basically these statistics. When I put in those statistics, it looks like a trade that on average will be a winner. That doesn't mean that there's also this risk that it's not a winner, and that is why professional traders are forced to trade very small, usually only 1% of the portfolio in each trade. And that is simply so that the probabilities have a chance to play out. Just think of the example when you're rolling the dice and you bet on number 6. If you just do one bet, you will probably lose all your money. But if you divide your money into 100 equal portions, the chances of you losing 100 times in a row, well, basically it's like the chance that you have to trade from the beginning, from the birth of the universe. It's extremely low chance, 1 in a million or billion, something like that. And you can also imagine if you have a portfolio with 8 assets and you do this on all 8, and you might figure out which one of them are correlated, so they will do more or less the same. Maybe I should move some from this to this one. That is what professional traders do. And that is why you cannot look at what they're doing. If they're selling or buying asset, might not mean that they think what they're selling will not go up more. It's just that they are overexposed. There are too many things correlating with this asset, so they need to diversify. And or they have another asset that they have a better expected outcome on. So even if they think this asset will be 90% chance keep going up 50% more, they might sell it. And people then interpret that these gurus knows that it's going to crash. No, they just had an expected outcome on something uncorrelated that were better, and then they do rebalancing. So this is a simple HTML and a web-based application. So I will share these files for the members so you can download it, and it doesn't cost anything extra. There's no subscription on it. You can just keep using it, and even if you download it and unsubscribe, you can still use it. And my idea is to keep building more of these, so I have my own quant apps that I'm using myself, and probably some of those might be interesting for others too. Thank you for watching today. Please share, like, comment, question, all these things, and hope to see you all soon again.